Introduction. Financial and management accounting are important for evaluating business performance and supporting decision making. This study compares the Mr. DIY Group and Berhad and EcoShop Marketing Berhad, where the two leading value retailers listed on Bursa Malaysia, to analyze their financial performance and management practices.
Our study target 4 strategic pillars. First, benchmarking financial performance. Second, interpreting core ratios. Third, identifying competitive strengths and weaknesses. And lastly, determining the optimal investment target for long-term growth. We utilize a quantitative comparative framework, extracted audited financial year 2035 data from Bursa Malaysia. Our analysis covered 12 critical ratios across liquidity, profitability, efficiency, and leverage to ensure a 360-degree performance evaluation.
Background of the company. Let's look at the first company, which is Mr. DIY. Firstly, Mr. DIY was established in the year of 2005. Mr. DIY has grown up to become Malaysia's largest home improvement retailer. Listed on the main market of Bursa Malaysia, they operate a massive retail network across Southeast Asia. Their business model revolves around always low prices across a massive catalogue of over 80,000 product lines. And as we will see shortly, managing this extensive inventory plays a major role in their financial matrices. Next, we have EcoShop, which was established in the year of 2003. EcoShop is one of Malaysia's leading value retail chains, specializing in ultra-affordable everyday essentials and groceries. They focus heavily on high volume, everyday accessibility across hundreds of nationwide stores. Both of these companies are major retail players, but their distinct inventory styles create a fantastic contrast in how they handle liquidity. Next is liquidity ratio. Firstly, we want to find the current ratios for both of the company. So, we need to use the formula of current asset over current liability. Here we could see that for the Mr. DIY company, we gain the value of current ratios of 2.24, meaning that for every RM1 of current liability, the company has RM2.24 of current asset to repay the current liability. For EcoShop, we gain the value of current ratio of 1.80, meaning that for every RM1 of current liability, the company has RM1.80 of current asset to repay the current liability. For comparison, Mr. DIY recorded a higher current ratio of 2.24 than EcoShop 1.80. This indicates that Mr. DIY has a stronger short-term liquidity position. Thus, Mr. DIY is in a better position to meet its short-term financial obligation than EcoShop. Next is quick ratios. The formula of quick ratios is current asset minus inventory minus prepayments over current liability. Here we could see that the quick ratio for Mr. DIY is 0.49, meaning for every RM1 of current liability, the company has RM0.49 of its liquid asset to repay the current liability. For EcoShop, we have 0.76 for its quick ratio, meaning for every RM1 of current liability, the company has RM0.76 of liquid asset to repay the current liability. For comparison, EcoShop recorded a quick ratio of 0.76 to Mr. DIY 0.49. This indicates that EcoShop has stronger ability to meet its short-term financial obligation using its most liquidity asset without relying heavily on inventory. Therefore, EcoShop has a better liquidity position compared to Mr. DIY.
Next, for the net profit margin ratio, Mr. DIY outperformed EcoShop by recording a significantly higher net profit margin. This suggests that Mr. DIY was more effective in converting sales revenue into net profit and managing operating expenses.
Mr. DIY demonstrates clear market dominance with a 47.52% gross profit margin, nearly doubling EcoShop's 28.22% by retaining 0.48 cent for every ringgit sold. Mr. DIY's superior cost control and pricing power drive its exceptional operational profitability. Mr. DIY takes a clear lead here, delivering a return on asset of 16.14% compared to EcoShop 11.06%. This means Mr. DIY generates roughly 5 cents more profit for every single ringgit invested in infrastructure and property, proving superior operational asset deployment. This ratio tracks how efficiently a company yields a return from its long-term funding pool, combining both equity and debt. Mr. DIY dominates this metrics at 28.66% over EcoShop 22.54%. This confirms that Mr. DIY is exceptionally optimal at compounding its long-term capital resource to drive high-velocity earnings for its stake.
Next, let's look at the inventory turnover ratio. EcoShop record an inventory turnover of 4.83 times per year, while Mr. DIY record 2.3 times per year. This means EcoShop sell inventory faster with stock remaining for about 70 days compared to 159 days for Mr. DIY. Therefore, EcoShop demonstrate more efficient inventory management. Okay, move to average collection period. EcoShop collect payment in 1.13 days, whereas Mr. DIY took around 6.8 days. This shows that EcoShop convert its credit sale into the cash much faster, which help improve its cash flow and daily operation.
Now, let we see total asset turnover. Mr. DIY had a total asset turnover ratio of 1.82 times, which means that the company generated around 1.28 of revenue for every 1 ringgit of assets used, while EcoShop had a total asset turnover ratio of 1.78 times, which means that the company generated 1.87 ringgit of revenue for every 1 ringgit of asset used. EcoShop performed better than Mr. DIY in terms of tidal asset turnover because it generated more sale from each 1 ringgit of assets.
Next, for the debt ratio, EcoShop performed better by recording a lower debt ratio. This indicates that lower dependence on external financing and a stronger long-term financial position. Next, for the debt to equity ratio, EcoShop recorded a lower debt to equity ratio than Mr. DIY, indicating lower financial risk and stronger financial stability. Therefore, EcoShop demonstrates a more conservative financing strategy.
Next, let we see interest earn ratio. Mr. DIY had an interest earn ratio of 12.0 at times, which means that the company could cover its finance cost of 12.0 times using its earnings before interest and tax, while EcoShop had an interest earn ratio of 10.39 times, meaning that the company could cover its finance cost 10.39 times using its earning before interest and tax. So the comparison that we could see is Mr. DIY performs slightly better than EcoShop in terms of time interest earned because it has a higher ratio. This means Mr. DIY has stronger interest coverage and lower financial risk in paying finance costs. Overall comparison, both Mr. DIY and EcoShop show strong financial performance but in different areas. For liquidity, Mr. DIY has better overall short-term asset coverage, while EcoShop has stronger immediate liquidity. In terms of profitability, Mr. DIY clearly performed better with higher profit margins, ROA and ROCE, showing stronger ability to generate returns. However, EcoShop is more efficient with faster inventory turnover and higher total asset turnover. For leverage, EcoShop has slightly lower debt risk, while Mr. DIY has better interest coverage. Overall, Mr. DIY can be considered financially stronger due to its superior profitability, while EcoShop stands out in operational efficiency and debt management.
Thus, in conclusion, both companies have their own strength. Mr. DIY performed better in terms of profitability and generating higher return. On the other hand, EcoShop is more efficient in managed inventory and collecting receivable. Overall, Mr. DIY has the stronger overall financial performance, while EcoShop stands out for its operational efficiency.